The Nvidia stock live price is currently trading at $220.74, down 1.22% in intraday market movement here on Friday, May 22. The Nvidia stock live price is currently trading at $220.74, down 1.22% in intraday market movement here on Friday, May 22, 2026. While the headline figures show a minor red slip on the daily chart, the hidden reality under the surface is far more telling. Just 2 days ago, the technology titan released its highly anticipated first quarter fiscal 2027 financial results, posting a massive beat on both top and bottom lines, with a staggering $81.6 billion in revenue and an adjusted $1.87 earnings per share. Yet, despite reporting a massive total net profit of $58.3 billion and announcing a massive $80 billion share buyback program, alongside a significant dividend increase, the equity is leaking valuation. The immediate instinct for many retail market participants watching this play out on their favorite online investing apps is to assume the top is in, or that the growth story has finally hit a brick wall. The actual development that most mainstream commentators are completely missing, however, is not a deceleration of business operations, but a fundamental realignment of sovereign capital allocations and severe domestic policy shifts within China that are changing how the chipmaker can recognize its international revenue. Specifically, the White House recently cleared roughly 10 major Chinese tech firms to purchase the high-performance H200 silicon under specialized licensing frameworks, yet not a single unit has actually shipped because Beijing has quietly ordered its domestic tech entities to stall purchases and focus on localized alternatives. This multi-billion-dollar standoff creates a temporary air pocket in international revenue recognition that standard technical models fail to capture. When you scan popular investing sites or log into your individual brokerage, the consensus narrative you see highlighted is that this business is simply priced for absolute perfection, and any reaction that is not a massive upward surge must mean the momentum is dying. This common ground belief is highly intuitive. After all, the asset has experienced a breathtaking rise, pushing its market capitalization above the $5 trillion mark and serving as the primary locomotive for the broader indexes. The conventional wisdom says that when a company prints record-breaking numbers and still drops, it is a clear structural warning sign. But challenging that assumption reveals a much deeper, contrarian truth about institutional behavior during major structural transitions. Large institutional funds utilizing sophisticated direct trading networks are not dumping shares because they think the business model is failing. Rather, they are managing a delicate operational transition between the current Blackwell hardware cycle and the upcoming Rubin architecture. The market is experiencing a temporary structural pause as hyperscalers adjust their near-term capital expenditure plans to align with the next product drop later this calendar year. Looking closely at the recent stock movement over the past few trading sessions, the daily swings paint a picture of intense institutional tug-of-war. Trading volumes have surged well above their historical moving averages, with over 200 million shares changing hands in yesterday's session alone. This heavy volume indicates that we are not seeing a quiet drop driven by lack of interest, but a high-stakes reallocation of assets. This sector momentum is feeling additional macroeconomic pressures from broader credit markets and shifting bond yields, which naturally compress the multiples of high-growth technology equities. If you check retail platforms like the Robinhood app or SoFi Invest, retail trading activity shows a massive influx of buy orders at these slightly lower levels, whereas the deeper institutional order flow shows sophisticated algorithmic distribution. This divergence highlights a distinct disconnect in sentiment between individual accounts managing self-investing strategies and multi-billion-dollar sovereign wealth funds that view the newly emerging sovereign field as a critical hedge against concentrated hyperscaler demand. Sovereign computing applications now account for roughly 14% of total company revenue, representing a $30 billion channel that is completely detached from standard corporate cloud budgets. For any retail participant utilizing online investment platforms, navigating these wild daily swings requires stepping back to look at the broader landscape of modern market access. Whether an investor chooses to deploy capital via automated systems like Schwab Intelligent Portfolios or prefers hands-on execution through an interactive broker's account, understanding the underlying plumbing of the market is absolutely vital. The modern landscape offers an unprecedented array of choices, from traditional legacy powerhouses like Fidelity Investments to modern fintech platforms like the SoFi Trading Platform or Robinhood Stock Trading. Each venue caters to different styles of engagement. An investor focused on long-term macro trends might favor Fidelity mutual funds, Fidelity ETFs, or tax-advantaged Fidelity IRAs managed through a dedicated individual brokerage account. Meanwhile, a shorter-term tactical participant might rely heavily on the execution speed and low fee structures found on the Interactive Brokers platform to navigate complex option chains or hedge their exposure during volatile earnings weeks. Even casual users checking market movements via the Robinhood app or using specialized tools like Robinhood Crypto and Robinhood Cash Management are now deeply plugged into these global corporate realities. The platform choice ultimately dictates execution efficiency, but it does not change the core fundamental reality that the underlying chipmaker is operating as the central toll booth for the modern computing world. Comment below how many shares of Nvidia stock you currently hold in your portfolio right now, and let me know if you are buying this post-earnings dip or waiting for lower levels. To truly understand why the equity is behaving this way, it helps to review exactly what this organization does and how its fundamental business model is structured. At its core, the company does not just design advanced processors, it builds complete, vertically integrated computing fabrics.
The core engine of their financial dominance is the data center segment, which recently posted a massive 92% year-over-year revenue surge to $75.2 billion. This business model relies on a proprietary software ecosystem called CUDA, which developers have used for decades to write accelerated computing applications. This software layer creates an exceptionally high barrier to entry, making it incredibly difficult for competing hardware firms or custom hyperscaler silicon to displace them. Historically, looking back at older reports and past performance, the company was heavily tied to cyclical consumer gaming markets and cryptocurrency mining trends. A few years ago, a drop in consumer demand could easily cause a multi-quarter revenue contraction. Today, however, the architecture has completely shifted toward enterprise infrastructure, where hardware compute revenues are supplemented by high-margin software licensing and networking ecosystems like InfiniBand. This structural change explains why past performance models that rely on old semiconductor cycles are no longer accurate indicators of how this massive enterprise operates in the modern corporate landscape. This brings us directly back to the core conflict between market expectations and structural reality as we look toward the future outlook. The market currently expects an uninterrupted, perfectly linear upward trajectory in capital expenditure from tech giants, assuming that every single quarter will feature an identical blowout surprise. The underlying reality, however, is that massive infrastructure buildouts naturally move in waves. There are three distinct future scenarios that could unfold over the next 12 to 18 months. In the most bullish scenario, the current Blackwell hardware shipments hold completely steady throughout the autumn, while the initial manufacturing ramp for the next generation Rubin chips executes flawlessly in the latter half of the calendar year, preventing any near-term drop in margins. The second, more neutral scenario involves a minor revenue air pocket over the next 2 quarters as major cloud providers intentionally delay a small portion of their component orders to ensure they receive the newest hardware iterations, causing the stock to trade sideways within its current 52-week range. The third, more bearish scenario would involve extended geopolitical friction where Washington introduces even stricter export limitations, while domestic Chinese entities permanently transition to internal suppliers, completely eliminating a $50 billion addressable market segment. When we weigh these potential catalysts and risks against current market valuations, the importance of maintaining an independent analytical view becomes crystal clear. Relying solely on basic retail investing sites or following crowd sentiment on the Robinhood app without understanding institutional order flow is a recipe for getting caught on the wrong side of sharp cyclical corrections. Navigating these environments successfully requires high-quality investment help and a disciplined approach to risk management, regardless of whether you manage your portfolio manually through interactive brokers trading or use automated models like a SoFi robo-advisor. The investors who consistently thrive are those who look past the short-term noise of a single afternoon's trading session and focus on where structural demand curves intersect with actual production capacity. To cleanly summarize the central insights of this market development, the recent post-earnings price movement is a textbook manifestation of expectations catching up to exceptional fundamentals. The company delivered historic financial results that would normally ignite a massive market rally, yet the stock slipped because the structural narrative had already anticipated near-perfect execution. The tension between the expectation of an endless upward surge and the reality of a complex product transition has created a near-term valuation disconnect. While short-term traders might react with panic to a minor red day on their Fidelity mobile app or SoFi active investing dashboard, the deeper analysis suggests that the long-term competitive advantages of the business remain firmly intact. The massive $80 billion share buyback program and the robust revenue guidance of $91 billion for the upcoming quarter serve as clear indicators of corporate health. Ultimately, this market reaction reinforces the ultimate rule of institutional investing. When the crowd is looking left at headline revenue beats, the smart money is looking right at international policy risks and architectural handoffs. By keeping your eyes on these deeper structural mechanics, you gain a lasting sense of market depth and true structural authority over your capital. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.